For a look at this morning's stock movers, let's welcome in Diane King-Hall. She joins me at the desk. So, Diane, you're on the huge movers beat today following earnings. I'm taking a look at the three names you're covering, all up or down, double digits. So
massively,
let's start with one of the big winners, and that's Pinterest. Shares up almost 20% after earnings. Fill us in on those numbers.
And they are managing, a lot of it hangs on the revenue number. Revenue topped $1 billion, so that was key for them because that was its first $1 billion quarter ever when it comes to revenue. Street shaking off the miss on adjusted EPS. Adjusted EPS was 56 cents a share. Revenue $1.15 billion. Again, that was better than expected. It had record high global users that surpassed 550 million for monthly active users. You saw growth of double digits in terms of active users. Again, the $1 billion quarter, more than $1 billion revenue quarter, that was an 18% jump in revenue growth. Part of that had to do with just ads and click-through on ads. They saw some really strong click-through on ads. They've been incorporating more AI into that, and that helped the click-through rate. Now, ad pricing did decline year over year. They accounted that to increase ad impression growth and then just a kind of a mixed shift. One thing that they don't do is they don't accept political advertising, so that can, kind of put a cap on the potential revenue growth for them, especially when you have these like election-related seasons of spending. So that caps it, but it doesn't mean clearly they perform very well. Another thing that we saw is just, again, the growth in monthly users that may have been a benefit from some of that shift that we saw and worries about TikTok. We've seen that activity around Meta platforms, et cetera, and other social media sites trying to capitalize on users looking for where else they can go. The company talked on their earnings call about AI. They were questioned about it. They said it's integral to the platform, enhancing the user experience and ad performance. They said, quote, we switched to GPU serving for better model performance and integrated LLM tech for features like guided search. So they're using more of those large language models for the guided search. And so they've seen, double-digit growth again. They're expecting double-digit growth for Q1. They're expecting 15 to 17% jump in revenue for Q1. They talked about increased advertiser value as a result.
But when you actually look at these numbers, adjusted EPS for the fourth quarter actually missed analyst expectations. Revenue only beat very modestly. So is this just about that uptick in daily active users? I mean, just to see a huge gain on these results. I'm just curious, is it about the outlook?
It's not just that. The outlook weighs as well, because the outlook now with the projection of between 837 to 852 million, Street's looking for 836 million. So it exceeds on both the low end and all the way to the high end. And we know often the Street looks at the midpoint of that. So they're expecting to see continued growth and continued strength. So, and then the miss was kind of attributed to some tax functionality on EPS. So it really is about the guidance and the growth in active users. And a lot of that is actually also global growth as well.
Okay, so not necessarily fundamental miss there.
That's
and I think probably being quite off the highs probably helps the setup in terms of this move higher. Moving on, Elf Beauty was already a loser this year and is adding to those losses, down about 25%. This was a high flyer at one point.
It was.
Hasn't been lately. What's going on there?
And we talked about that as well. It's got some headwinds that the top brass say is unique to this quarter. We'll see, because clearly the Street is not willing to give it a lot of grace here. Adjusted EPS was 74 cents a share. That was a miss. Revenue was $355.3 million. That was actually better than expected. They said on the earnings call about the dynamics between Q3 and Q4. The CEO said, we do not believe Q4 is indicative of the underlying run rate of our business. Remain confident in the ability to deliver market-leading growth. Clearly, the Street is not in agreement with this, given the price action that we're seeing and even some of the analysts' reaction. The other issue here is they've downgraded their outlook. The update for fiscal 2025, now they're expecting sales growth of between 27 to 28%. Previously, 28% was the low end and 30% was the high end. So that is not a good setup for that as well. In terms of the second half, they said their guidance reflects 14 to 16% net sales growth amid, they called it, this was literally what they said, the backdrop of a challenged mass cosmetics category. Some of the other takeaways in the earnings call, they said consumers were focused elsewhere. Their mind share is focused elsewhere. They talked about the wildfires in LA, uncertainty about TikTok. So they blamed, it seems like they're trying to say that this quarter is unique. That remains to be seen, though.
Yeah, I could see that, though, because I feel like e.l.f. is so associated with some of
TikTok.
those Gen Z influencers, and that's how they've really been able to, see growth in their business.
Right.
And the thought of TikTok, being banned, all of a sudden, a lot of people technically without their influencer jobs, and also the California wildfires. It seems like a lot of the influencers I followed, for sensitivity reasons, didn't post about it.
Sense.
And if that's not driving sales, it'll be interesting to see how that plays out. You mentioned the analyst community. I did see some downgrades.
There are.
Fill us in on those.
So UBS downgrading e.l.f. to a neutral from a buy. Their new price target is $74 a share. They previously had a price target of $158 a share. Morgan Stanley has downgraded e.l.f. to equal weight from overweight. They've got a price target of $70 a share. They previously had it at $153 a share. D.A. Davidson has downgraded it to a neutral from a buy. Their price target is $80 a share. That's down from $170 a share. So obviously some distance between where e.l.f. is today still between their new price targets, but it's clear that the analyst community had to do a reset off the back of this quarter, especially given, as you mentioned, about how high flying e.l.f. had been.
Yeah, I think the fact that it's down 25% actually makes all those price targets higher than where it's currently trading.
Right,
so at least they see some growth despite those neutral calls. All right, finally, you're looking at Expedia. This is a name that was down year to date. Now it's positive, up about 14% after earnings. What does Wall Street like from that one?
Yeah, and it's Expedia needed this win, especially in the context of how it's been trading compared to, for instance, Booking. Adjusted EPS was $2.39 a share. That beat on both the top and bottom line. Revenue $3.18 billion. The Street was looking for $3.07 billion. They saw growth, a lot of growth internationally. There was also growth in the U.S., but that was in the single digits, like high single digits. But it was abroad where you saw a lot of that growth. Asia Pacific, European region, Asia Pacific, that was helped by both some cross-border travel, and then some visa restrictions had been lifted there. Europe, there was both domestic and long-haul travel from U.S. travelers to Europe. Off the back of this, just a quick quote from the CEO saying, quote, travel demand remained healthy in Q4 despite price increases. International demand was stronger than in the U.S., which was similar to the prior quarter. Off the back of this, they are reinstating their quarterly dividend after, they dropped it like during the pandemic. So that bodes well. That's a strong sign of confidence.
Yeah, returning some cash to the shareholders there. I think that, basically in line with what we've been hearing from the airlines, too. This is very much a consumer that will continue to spend, and they want to do so on travel, especially international travel. So, shares up 15%.
Indeed, and you are seeing again some analysts updating their price targets. I was looking for this earlier. Clearly, analysts hadn't had a chance to adjust. I was looking for this around 8 a.m., but now you are starting to see some of the analyst community respond. D.A. Davidson boosting their price target on Expedia to $205 a share. They are, though, maintaining a neutral rating. B. Riley has boosted their price target to $235 a share, keeping a buy rating on that one.
Yeah, it seems like the majority of analysts very much in the hold camp for Expedia.
Right.
And the median price target now has been notched higher to about $200 a share, basically in line with where it's currently trading. So we'll keep an eye on that one.
Indeed.
Diane King Hall, thanks so much.